Welcome to another Deep Dive View.
Great to be diving in again.
Today we're cracking open a really fundamental part of keeping the financial world honest. International Standard on Auditing 501.
ISA 501, yep.
Yeah.
It's all about audit evidence for specific things.
Exactly. We're going to pull out the most important pieces about how auditors get, well, solid proof for some of the big ticket items you see on a company's books.
Things like inventory, legal issues.
Right. Think of this as your backstage pass to understanding how those financial numbers get the thumbs up. Our goal is to take this professional auditing standard, ISA 501, and make its core ideas clear and useful for you.
Without getting totally lost in the jargon.
Hopefully. We're focusing on three key areas: inventory, litigation and claims, and segment information. So yeah, let's get started on this deep dive.
Absolutely. Because at the heart of any financial audit, you need solid evidence. It's fundamental.
Right.
And ISA 501 gives specific guidance on how auditors gather what we call sufficient appropriate audit evidence for these particular items.
Sufficient and appropriate. Okay.
Yes. Exactly.
Yeah.
Because these areas, they often carry significant risks. They're really crucial for showing a true and fair picture of a company's financial health.
Okay, let's jump right into inventory then. For so many companies, this is huge, right? It could be raw materials, stuff being made, finished goods.
Absolutely. Raw materials, work in progress, finished goods. It's often a massive asset on the balance sheet.
So because it's so central, auditors spend a good amount of time on it. What's the main thing they're trying to figure out?
Well, the primary objective for auditors with inventory, like ISA 501 lays out, is getting enough good evidence about two main things.
Okay, what are they?
One, does the inventory actually exist? Is it physically there?
Right, physically there.
And two, what's its condition? Is it in good shape, or is it maybe damaged, obsolete, past its sell-by date?
That makes sense. Condition matters for value.
Definitely. And if inventory is what we call material, so significant enough to possibly sway decisions of someone reading the financials, and if its condition is a risk factor, then the auditor really needs to dig in thoroughly.
Okay. So one of the really hands-on things auditors do, which I think people might have heard about, is actually being there for the physical inventory count. It sounds like they're rolling up their sleeves.
They are, yeah. Unless it's genuinely not practical, and we can talk about what that means, the standard says the auditor has to attend the physical inventory counting.
Why is being there so important?
Well, being there lets them do some critical things. First, they'll look at how management has planned and set up the count. Are the instructions clear? Sensible.
Okay. Evaluating the plan.
Then they'll watch the company's own people actually doing the count. Are they following the procedures correctly?
Observing the process itself.
Yep. And they'll take a good look at the inventory itself, get a feel for what it is, its condition, like we said.
Inspecting the actual goods.
And importantly, they'll perform their own test counts.
Ah, so they count some themselves.
Exactly. They'll pick some items, maybe from the shelves, and check if the quantity matches the company's count records. And they also do it the other way around.
The other way.
They take items listed in the records and see if they can actually find them on the shelves or in the warehouse.
Got it. Checking both directions for completeness and existence. Okay, so it's not just watching, they're actively verifying stuff.
That's the key. Active verification.
And after the physical count is done, what happens then? Is that it for inventory?
Oh, no. After the count, the auditor then looks at the company's final inventory records, the ones that feed into the financial statements.
Right.
They need to make sure these final records accurately reflect what the physical count actually found. Sometimes there are differences.
Discrepancies.
Yeah, discrepancies. And the auditor has to understand why those happen and if they've been properly resolved.
Now, what if the company does its big inventory count, say, in November, but their financial year ends December 31st? That seems like it could complicate things.
It does add another layer, you're right. In those cases, the auditor has to perform extra procedures. They need evidence about any changes in inventory levels that might have happened between that count date in November and the year-end date.
Like what kind of procedures?
Well, they might look closely at records of inventory coming in purchases and inventory going out sales during that specific period, that gap between the count and year-end. It's often called roll-forward procedures.
Okay, roll forward. Got it. And what if it's just not feasible for the auditor to be there for the physical count? You mentioned that possibility. Maybe the inventory is, I don't know, on a ship somewhere or in a really dangerous location.
Right. If attending is genuinely impracticable, Maybe the location poses serious safety threats, or it's extremely remote, and the cost is prohibitive compared to the risk. Then the auditor has to find other ways,
Other ways.
alternative audit procedures. They need to try and get sufficient appropriate evidence about the inventory's existence and condition through different methods.
Like,
It depends heavily on the situation. Maybe examining documentation very closely, subsequent sales records, potentially relying on reports from other auditors if available.
okay. But what if those alternative methods don't work? What if they still can't get enough proof?
Well, this is important. If those alternative procedures don't give them the necessary proof, it can seriously impact the auditor's final report.
How so?
They might have to issue what's called a modified opinion, basically signaling to the readers of the financial statements that they couldn't get enough assurance about the inventory figures. It's a significant qualification.
So it's a big deal if they can't get the evidence. That makes sense. What about inventory that a company owns, but it's being held somewhere else, like in a third-party warehouse or on consignment?
Good question. If that inventory held by someone else, a third party, is material, is significant, the auditor still needs that assurance about its existence and condition.
So how do they check that if it's not on the company's premises?
ISO 501 suggests a couple of main routes. One is to directly ask the third party who's holding the inventory, send them a request to confirm the quantities and the condition of the goods they're holding.
Like sending a letter or email.
Exactly. It's called obtaining a confirmation. Alternatively, or maybe in addition, the auditor might actually go and inspect the inventory at the third party's location, if possible. Or they could perform other procedures, like looking at the third party's own reports or documentation about the inventory.
So again, choosing the right approach for this situation, it seems like it's all about getting that reliable evidence wherever the inventory happens to be.
That's the essence of it. Sufficient appropriate evidence.
Okay, let's maybe dive a bit deeper into what the auditor is actually doing when they do attend a physical inventory count. You mentioned observing, inspecting, test counts. What are some specifics?
Sure. So usually it's the company's management who sets up the procedures for their regular inventory counts. They should have instructions, a plan. When the auditor attends, their work, as we said, involves inspecting the inventory, literally looking at it, observing if the company's staff are following their own count procedures properly.
Catching any shortcuts, maybe?
Potentially, yes. And performing those test counts we discussed.
Okay, those are the actions. But what kind of things do they need to think about and plan for before they even go, or while they're there?
Good point. Planning is key. They'll consider several things. What are the biggest risks of errors or misstatements related to this inventory? How good are the company's internal controls over inventory generally?
So, assessing the risk first.
Definitely. They'll also review management's instructions for the count beforehand. Are they adequate, clear, complete? The timing of the count matters, the specific locations where inventory is held.
If it's in multiple warehouses, for instance.
Exactly. And they also need to consider if they need help from an expert. Maybe the inventory is highly technical, like chemicals or complex machinery, or hard to measure, like, huge tiles of coal or grain.
Right, you might need a specialist, surveyor, or engineer.
Precisely. The auditor needs to recognize when they need that specialized skill.
You mentioned the auditors evaluate management's instructions. What specifically are they looking for in those instructions? What makes them adequate?
They want to see if the instructions cover all the important bases. Things like how control procedures should be applied during the count, how staff should accurately identify the stage of completion for any work-in-progress inventory.
Like, is this widget half-built or almost finished?
Exactly. And the methods used to estimate quantities for things that can't be easily counted individually, those big piles of materials, for example. There should be a defined methodology.
Okay.
And crucially, how the company controls the movement of inventory between different areas during the count itself. You don't want things being counted twice or missed. Plus, ensuring there are clear cutoff procedures.
Cutoff? What's that?
That means making sure that goods received right before the count are included and goods shipped out right after are excluded, and vice versa. Getting that timing right around the count date is vital to avoid errors.
Ah, okay. So no double counting or missing things shipped or received right at that moment.
That's the idea. Control over shipping and receiving cutoff.
And when the auditors are actually there watching the count, what are they paying closest attention to?
Well, their main focus is seeing if the company's own count procedures are being carried out properly. Like we said, are people following the instructions?
Spotting deviations.
Yes. And they're also actively looking for any inventory that seems old, damaged, slow-moving, or obsolete, because that might need to be valued lower, written down in the financial statements.
So identifying potential valuation issues as well as existence.
Correct. It ties back to that condition aspect we mentioned earlier.
And those test counts you mentioned going both ways, from the count to the records and records back to the physical items. Why is doing both directions so important?
It gives much stronger evidence. Checking from the physical items they count to the company's records helps make sure everything that's physically there actually gets recorded. Completeness. And going from the company's records back to find the physical items helps verify that the inventory the company claims to have on its books actually exists. Existence.
So completeness and existence. Doing both covers those key assertions.
Precisely. It makes the evidence much more robust.
We briefly touched on what happens if the physical count isn't right at the year end. What about companies that use, what are they called? Perpetual inventory systems.
Ah, yes. Perpetual inventory system.
Where they keep a running tally all the time. Does that change how the auditor approaches things?
It does change the timing and nature of some procedures. If a company has a reliable perpetual system, think of it like a constantly updated inventory log. The auditor might not need to rely solely on a single year-end count.
So they might test it differently.
Yes. They'll still perform substantive procedures on the inventory quantities, but this often involves doing test counts at various points throughout the year, maybe on a cyclical basis or during an interim audit visit before year-end.
Okay, testing it at different times.
Right. And when they're planning these tests, they'll look at how well the company maintains that perpetual system. Are the records accurately updated for purchases, production, sales? Are discrepancies investigated promptly? They'll compare the perpetual records with their own physical counts to check accuracy.
So the quality of the perpetual system itself becomes important.
Very important. If it's weak, the auditor might need to do more testing, perhaps closer to year-end, or even insist on a full physical count at year-end despite the perpetual system.
It really sounds like auditing inventory is, well, quite a detailed and thoughtful process. There's a lot more to it than just ticking a box.
Oh, absolutely. It requires careful planning, execution, and judgment.
Okay, let's switch gears then. Let's move to another important area covered by IS 5001, litigation and claims. This sounds like lawyers and lawsuits.
It is. It's about gathering evidence on potential legal issues a company might be facing.
Why is this so crucial for an auditor?
Well, lawsuits and claims against a company can have a really significant impact potentially on its financial statement.
No.
They could lead to large payouts, which need to be accounted for or disclosed. In extreme cases, a major lawsuit could even jeopardize the company's ability to continue operating what we call the going concern assumption.
Wow, okay. So the stakes can be high.
Very high. So the auditor's main goal here under ISIS 501 is to identify and assess any legal issues, litigation, claims, assessments that could create a risk of a material misstatement in the financials.
So how do auditors actually find out about these potential legal problems? I imagine companies aren't always eager to advertise them.
No, not always. ISIS 501 outlines several key procedures. First, and perhaps most obviously, they ask. They inquire of the company's management.
Just to ask them straight up.
Yes, ask management, and where relevant, others within the company, like the in-house legal counsel if they have one, about any ongoing lawsuits, threatened litigation, potential claims, anything they're aware of.
Okay, inquiry is step one. What else?
Second, they review minutes. Minutes of meetings of the board of directors, audit committees, other governance bodies. These minutes often document discussions about significant legal matters.
Makes sense. Looking for mentions in official records.
Third, they look at correspondence between the company and its external legal counsel. Letters, emails, legal opinions related to litigation and claims.
Getting insight from the outside lawyers.
And fourth, they review the company's legal expense accounts in the general ledger.
Why the expense accounts?
They're looking for clues. Unusually large legal fees or payments to law firms they weren't aware of might indicate undisclosed legal issues or disputes. It's another way to potentially uncover things.
Right, following the money trail. Okay, so inquiry, minutes, correspondence, and legal expenses. And if the auditor does find something through these steps that looks like a potential material issue related to litigation, what's the next move?
If they identify something that seems potentially significant, the standard generally requires the auditor to seek direct communication with the entity's external legal counsel.
Talk directly to the company's lawyers.
Yes, usually through a formal letter of inquiry, often drafted by management, but sent by the auditor. This direct communication is really important. It helps the auditor get an independent assessment from the legal experts about the likelihood of an unfavorable outcome and the potential range of financial loss, if any.
Getting it straight from the horse's mouth, so to speak.
Yeah.
The legal expert's view.
Exactly. Their professional judgment on the matter.
But what happens if the company's management says, no, you can't talk to our lawyers? Or maybe the lawyers themselves refuse to respond, citing confidentiality.
That's a serious red flag for the auditor. If management refuses to give the auditor permission to communicate with their external lawyers, that's a major scope limitation.
Scope limitation, meaning they can't do their job properly.
Essentially, yes. They're being prevented from obtaining potentially crucial audit evidence. Similarly, if the external legal counsel refuses to respond appropriately or states they're prohibited from responding fully, that also limits the auditor's ability to gather evidence.
So what's the consequence of that?
In those situations, the auditor has to consider the impact on their audit opinion. It could very likely lead to a modification of the opinion, either a qualified opinion or, in severe cases, even a disclaimer of opinion, meaning they couldn't form an opinion at all.
So it really undermines the credibility of the audit if that communication channel is blocked.
Absolutely. Transparency with legal counsel is key.
The standard also mentions something called written representations in this area. What are those about?
Right. The auditor is required to ask the company's management, and sometimes those charged with governance, like the board, to provide formal written statements. These are the written representations specifically about litigation and claims.
What do these statements say?
Management essentially confirms in writing that they have disclosed to the auditor all known actual or possible litigation and claims whose effects should be considered when preparing the financial statements. And they confirm that these matters have been properly accounted for and disclosed according to the relevant accounting rules.
So it's management putting it on record.
Yes, it's another piece of audit evidence. But it's important to remember, these written reps supplement other evidence. They don't replace the need for the auditor to perform those other procedures, like inquiry and reviewing correspondence. You can't just rely on what management tells you in writing.
Got it. It's corroborating evidence, not primary evidence. And I notice a mention in the outline about understanding the company's communication with their lawyers and the concept of legal privilege. Why is that relevant?
Well, understanding the nature of the communication helps the auditor assess the situation. But the concept of legal professional privilege, which protects certain communications between a lawyer and their client from being disclosed, can sometimes create challenges.
How so?
It means there might be information discussed between the company and its lawyers that the lawyers are legally prevented from sharing directly with the auditor, even if the auditor asks. Auditors need to be aware of this legal framework and navigate it carefully while still trying to gather enough appropriate evidence through permissible means.
So it's a delicate balance, respecting legal privilege while still doing a thorough audit.
Exactly. It requires professional judgment and often careful discussion with management and potentially the lawyers about what information can be shared.
Okay, it sounds like navigating the legal side requires a very careful, methodical approach. All right, let's move on to our last main area under ISA 501, segment information.
Segment information, right?
For bigger companies, maybe multinationals or conglomerates, they often break down their financial results by different parts of the business, different product lines, or geographical regions. That's segment information, right?
That's exactly it. If the applicable financial reporting framework like IFRS or US GAAP requires a company to report information about its different operating segments, then that information becomes part of the financial statements that the auditor is auditing.
So what's the auditor's role here specifically?
The auditor needs to obtain sufficient, appropriate audit evidence regarding the presentation and disclosure of that segment information. Basically, they need to check if it's done correctly according to the rules.
Making sure the breakdown makes sense and follows the accounting standards.
Precisely. They need to be comfortable that the way the company has carved up its business for reporting purposes and the numbers they've reported for each segment are appropriate and properly disclosed.
So how do they go about auditing this? It's not like they're doing a whole separate mini audit for each segment, are they?
No, generally not a full separate audit per segment. Their work is more focused on understanding and checking how management determines and reports this segment information.
Okay, so understanding the how, what does that involve?
It involves a few key steps outlined in ISA 501. First, the auditor needs to get an understanding of the methods management uses to identify its reportable segments and to allocate revenues and costs to them.
Figuring out their methodology.
Second, they need to evaluate whether these methods are actually likely to result in segment disclosure that complies with the applicable accounting framework.
Hmm.
Do the methods seem reasonable and consistent with the rules?
Assessing the methods themselves.
Third, where it's appropriate, they'll actually test the application of those methods. For example, checking calculations, tracing data used for segment reporting back to the company's main financial systems.
Testing the calculations and data.
And fourth, they'll perform analytical procedures or other audit procedures that seem appropriate. This might involve comparing segment results over time, looking at ratios within segments, or comparing segment performance to budgets or industry data to see if it looks reasonable.
Looking for anomalies or inconsistencies.
Exactly. Does the story the segment data tells make sense?
You mentioned understanding management's methods. What kind of things would the auditors be looking at there specifically? What defines a segment, for example?
They'd look at how management identified its operating segments in the first place. Is it based on the nature of products or services, geographical areas, the structure used for internal reporting to the chief decision maker? The accounting standards have specific criteria. They'll also examine how things like sales between segments, intersegment transfers are measured and disclosed. They might compare segment revenues, profits, and assets to the company's budgets or forecasts for those segments.
Comparing actuals to plans.
And consistency is important too. They'll check if the methods used to determine segment information are consistent with those used in the prior year. If there's a change, is it justified and properly explained?
Right, consistency or clear explanations for changes.
Yes. So all these things help the auditor understand if the segment reporting is reliable.
And what if a company is required to report segment information, but maybe it's just discussed in the notes to the financial statements, not presented in big tables up front? Does the auditor still need to audit that information in the notes?
Yes, absolutely. The location doesn't matter as much as the fact that it's part of the audited financial statements. Whether it's in tables or narrative disclosure in the footnotes, if it's required by the framework, the auditor needs to perform procedures to get sufficient appropriate evidence about it.
So even if it's buried in the notes, it still gets audited.
It has to. It's all part of forming their overall opinion on whether the financial statements as a whole are presented fairly, in accordance with the framework. Segment information is an integral piece of that puzzle for many companies.
Okay, that gives us a really good overview of how auditors tackle inventory, litigation, and claims and segment information under ISA 501. It's clear there's a lot more involved in an audit than just, glancing at the final numbers on the page.
Exactly right. ISA 501 provides that specific, targeted guidance for getting the necessary evidence in these critical areas. It recognizes their significance and, frankly, the potential for things to go wrong if they're not audited carefully.
Yeah.
Understanding these procedures really shows the depth and the rigor involved in a proper financial statement audit.
So just to bring it all together then, we've taken this deep dive into ISA 501.
Yeah.
We've seen how auditors gather that crucial evidence for inventory, often by physically being there, counting, observing.
Checking existence and condition.
Right. For litigation and claims by asking management, checking records, and trying to talk directly to the external legal expert.
Identifying and assessing potential liabilities.
And for segment information, by understanding and testing how companies actually break down their business results according to the rules.
Ensuring fair presentation and disclosure.
And these steps, they're so important for the auditor to ultimately be able to say with confidence whether a company's financial statements give a true and fair view.
Precisely. And as we've discussed, it's not just about ticking boxes. It's about applying professional skepticism and judgment to gather enough of the right kind of evidence to really back up their conclusions.
Yeah.
The challenges involved, dealing with inventory counts, navigating legal privilege, understanding complex segment allocations. It all highlights the really important role auditors play in building trust and confidence in financial reporting.
That's a great way to put it. Builds trust and confidence. And it makes you think, doesn't it? You, the listener. It makes you wonder. How do you make sure you have sufficient appropriate evidence before making important decisions in your own life?
That's an interesting parallel.
Yeah. Whether it's, researching a big purchase like a car or a house, or deciding on an investment, or even just figuring out what news or information online to actually believe. The idea of looking for reliable sources, cross-checking information, thinking critically about what you find, it's surprisingly similar to the core principles of what auditors do, isn't it?
It really is. that need for reliable evidence before forming a judgment.
Definitely something to keep in mind, maybe mull over long after this deep dive. Thanks for joining us.
Thanks for the great discussion.